What's going on, everyone? 2022 has been a year thus far, especially following after the whole pandemic, COVID. Now we're battling inflation. We're now going through a war over there with Ukraine and Russia, and we're going through what we call economic correction, right? And so I have plenty of clients, plenty of people asking me, how can I become a homeowner? What can I do in 2022 now that the housing market is the way it is, right? I'm sure you guys have heard of the um, multiple offer situations, the battles, houses coming onto the market at 12 p.m. on a Friday and being sold 30 minutes later, right? People paying all cash. But the thing is, there's plenty of first-time home buyers. There's plenty of second-time home buyers and third-time home buyers that might not be able to take advantage or actually pay cash for our home, right? So what do they do is the question. And so today we're actually going to go over the top 5 things that you must know in order to purchase a home in 2022. So let's go ahead and get right to it. Welcome back. So let's talk about the 2022 housing market. We've seen a drastic increase in the housing interest rates, right? We've also seen a drastic increase in housing prices. And now that we're seeing the increase in interest rates happening so very often, I'm starting to see a small correction of the housing prices, not more so a decline in the market, but more so of a plateau of where the housing prices should be, right? So maybe like 10, 15, $20,000 reductions here and there, right? And that's just because the market is not does not have as many buyers as it did prior to, right? Think about this. We had record low interest rates maybe 7, 8 months ago, a year ago. And now that interest rates are increasing, that's going to drive the amount of buyers just down just because they might be getting priced out. They might not be able to hold the competitive advantage with the higher interest rates to purchase a home to win those, multiple offer situations. So, and that was by design, right? The interest rates are rising to slow the housing market down just a little bit, right? And that's what we're seeing. So, as a first time home buyer, second time home buyer, third time home buyer, coming in and saying, "Hey, look, I still want to buy a home. I still, need a place to stay, and I don't want to pay these, all-time high rents, right? Because at the end of the day, you're paying a mortgage, and the question is whether it's yours or not. So you're paying, 15, 16, $1,700 a month in rent for somebody else's mortgage. Why not pay for your own? And I know that the argument is, well, mortgages are a lot more and this and that, but at the end of the day, the house is still yours. You're still going to see that money back at whenever you either sell it. You could use the property as an investment property, whether you want to rent it or you could do short-term rentals as well, like Airbnb, VRBOs. And there's just so much more you can do when the asset is yours, right? Because at the end of the day, like I said, you need a place to stay. So the number one thing, or one of the top things that I want to discuss today, is your credit score. Your credit score is super, super important, especially now in today's times, because we already know the interest rates are higher than what they were, 12 months ago, 18 months ago. And interest rates are directly impacted on your credit score. So you want to have the best credit profile that you can have in today's housing market, right? And the thing is, you can actually control your credit score. And the way you do it is you have to understand how the scores are broken down, or how the models calculate your scores. Because at the end of the day, your scores are created off of the data. the data that is inputted into the specific algorithm, right? And the specific algorithm is called FICO, in which these banks are calculating your scores. And that's not the Credit Karmas of the world or the Vantage scores of the world, because it's actually called the Vantage score, right? And it's just calculated differently. But I'll create another video to kind of break down the scores and the exact scores that the mortgage brokers and the banks are looking at to qualify you for your home. So let's talk about your credit and how you can actually control your credit score. You have to understand that it's broken down into the 5 different factors, right? First one is going to be payment history, and that's going to be 35% of your score, which is the biggest impact that you can have on your score. The second category is your utilization, right? Or the amounts owed. And that's like your credit cards, how much you owe on your credit cards and your balances, right? And that's going to be 30% of your score. The third category is actually going to be your credit history, just basically how long you've had credit, right? Because the way the banks look at it is they want to see that you've been responsible for an extended period of time. So your credit history has a 15% impact of your score. The fourth category is going to be the types of credit, which is going to be broken down into your installment loans or installment accounts and your revolving accounts as well. Basically, installments are like credit or your mortgage or your car payment, things like that. Revolving accounts are like credit cards, like you use it to buy gas and then you pay it off and then you can use it again. They just want to see you're responsible with multiple different types of credit, right? And then the fifth category is going to be basically your inquiries, how often you apply for credit. Because if they look and see that you're applying for credit very, very often, that's going to raise a red flag. Like, why do they keep applying for credit? What do they need? What are they doing? Right? So that's going to raise a red flag. And both of those, the types of credit and the inquiries section, both equal 10%. So it's going to be 35, 30, 15, 10, 10 to equal 100% of your score. And if you actually understand how you can control those categories, you actually can you can take control of your credit score. So that's good to know. Second thing that I want to go over is your budgeting. That's going to be huge, huge, huge. Whether or not you're using a grant or down payment assistance or a specific homebuyer program, right? You still want to budget. You still want to be responsible with your money, because at the end of the day, buying a home is going to be one of the, if not the biggest purchase of your life, right? Whether it's going to be your first, second, third home, it's going to be one of the biggest purchases of your life, and you must budget, because whenever you get into a home, it doesn't end there, right? You have to maintain the home. You have to make sure it's in good standing. You have to replace the fence, the roof, whenever it needs to be replacing, right? It's an investment. So you need to budget. And also, whenever you're trying to get qualified for these loans or for a home, a lot of times the lenders want to see reserves, and it could be 3 months worth of reserves, 4 months, 5 months worth of reserves sitting in your bank account. What I like to tell my clients is, you want to have at least 2 different types of savings. You want to have an emergency fund savings, and that's just for the accidents, right? That if your tire blows, then you have enough funds to go get a new tire, or you need an oil change, or something happens, right? And then you want to have a home buyer savings, specifically geared towards your home buying process, because there are fees included with the home buying process, whether that's, earnest money. And we'll get into that in different videos. We have earnest money, you have option money, you have inspection fees and appraisal fees, right? And there are things like seller's concessions, and I'm starting to see a little bit more of that, just because the market is slowing down just a little bit, just because the interest rates are higher. So there are seller's concessions, but at the end of the day, you still want to have, reserves in your accounts for emergency funds and your home buying process. And if you don't use it, then great. That's just extra money that you can, either save, invest elsewhere, or, buy furniture, whatever you need to do, right? So make sure you sit down and put a budget together. Calculate all your debts, calculate all your income, all your debts, and make sure whenever you're doing your budget, account for those two different types of savings, whether it's, $100 every 2 weeks, or whatever, every time you get paid, or 200, 250, right? Make sure that, you're comfortable with what you're doing, and you can afford what you're doing, and you're still able to, live comfortably, and, pay for all of your necessities. And that kind of leads us to our third category, or the third thing that I wanted to talk about, which is your DTI ratio, or your debt to income ratio. And that's going to be something else that the lenders look at whenever they're qualifying you for your home, right? So your debt to income ratio is basically, they're going to calculate all your debts that's going out every month, and they're going to calculate all your income that's coming in every month. And it has to be under a specific percentage, depending on which home buying program that you're using, or home buying loan that you're using, right? And I know a lot of people, are interested in grants, home buying, different home buying programs for first time home buyers, second time home buyers, things like that. And there's different requirements, and as far as the DTI, because some of them might, allow 55% debt to income ratios. Others might only allow 43% debt to income ratios. So you have to really sit down and understand, what your goal is, and work towards that goal. And that's super, super important, right? Um, Fourth thing that I wanted to discuss is your tax returns. Tax returns are huge, huge, huge. If your taxes are not done, you're not going to get approved for a loan, right? You're not going to get approved for a mortgage, because what lenders want to look for is at least 2 years of tax returns, right? And they want to go back and just look at your history, because they want to make sure that everything that you say that you're making is accurate, right? All the income that you've gotten, and whether you're a W-2 employee, or you're a 1099 worker, right? If you're a W-2 employee, you have to have at least 2 years of W-2 employment. And same for 1099. If you're a 1099 contractor or a worker, you need at least 2 years of that. And that kind of goes into, then that kind of brings up the fifth thing that I wanted to talk about, is work history, right? Work history is super, super huge. And most lenders, for most loan programs, look at least, they want to see at least 2 years of consistent work history. Now, I get a lot of times I get people saying, "Hey, I switched jobs, or I changed jobs, or I quit my job," and that's perfectly fine. What they want to see is, responsibility, that seeing that you're working, you don't have a bunch of lapses in your work history, right? So let's say you did switch jobs, and you basically, they want to see that you're in the same type of field, right? And it can kind of get, it's kind of a gray area there, which is fine. But if we can connect the dots, and connect, okay, they worked here, and this is a similar industry, right? Then we can connect the dot. So you kind of understand the five things that we went over today, right? We went over credit, which is huge, huge, huge. We went over the breakdown of how the credit score is calculated, right? We went over budgeting, how to budget, and what two types of savings to have during your home buying process whenever you're trying to purchase your home. We went over debt to income ratio, right? And the different maximums that you can have for specific loan types or programs. But that goes hand in hand in budgeting, right? Whether you need to pay off some bills, whether you need to pay off, or pay down some credit cards, right? And that just takes some, researching, some time, just to sit down and look at your finances. Fourth thing that we went over was the tax returns. Your tax returns are huge, huge, huge. You're not going to be able to get approved for a home if you don't have at least 2 years worth of the most 2 years worth of your pay stubs, right? And for right now, we're looking at 2020 and 2021 tax returns, because it's 2022. And then the last but not least thing that we went over is work history. Work history is huge. So just make sure that, you understand all those things, and take into account what, we discussed here today, and really sit down and write these things down. Look at your finances, look at your specific situation, and put a plan together to execute on, so that you can purchase your home within the next 6 to 12 months, right? So that's about all I got for today's video. I'm going to be, dropping videos, multiple videos a week. So go ahead, like, subscribe. and comment if you have any questions, guys. I'm going to be here for you. This is a very new YouTube channel, so I'm here for you all. Also, what I'm going to be, what I do have for you is I have a free list that you can actually download. It's a free list of the top 10 home buying programs in 2022 that I'm using for my clients. So go ahead, if you would like that list, go ahead. The link is going to be in the description of the top 10 home buying programs in 2022. So I'll see you guys next time.